Hello and welcome to a CMS Forex daily video recap. I'm your fundamental market analyst, Nick Nassat. Today is Friday, July 23rd, 2010. Let's begin with today's big event, the release of Eurozone bank stress tests, which were set out to gauge whether Europe's banking sector has sufficient capital in case the Eurozone economy suffered another, more severe shock than what we had seen in the financial crisis. There were a couple of risks associated with the tests. A result in which all banks passed would be seen as too lenient and would not go far enough to restore confidence in the Eurozone's financial system. However, if too many banks failed, it could spook investors as they see the Eurozone banking sector still mired in the sovereign debt crisis. The adverse test scenario assumed a double-dip recession, a 20% decline in equity markets, and a sharp rise in interest rates. That included the credit ratings on securitized products were downgraded by 4 notches across the board, and that short-term interbank borrowing rates rose by 125 basis points, similar to what happened after the Lehman Brothers collapse. There was also the adverse scenario with sovereign debt shock, which meant that there would be haircuts or discounts on sovereign debt. Based on the value of the bonds at the end of 2009, 5-year Greek bonds at the end of 2011 would face a discount of 23.1%, with the equivalent for Portuguese, Spanish, and German bonds set at 14%, 12.3%, and 4.7% respectively. As the results came out, we saw that 7 banks failed their criteria, which meant that they would have less than 6% of Tier 1 capital in the adverse case. Germany's Hypo Real Estate, Greece's ATE Bank Group, and 5 Spanish banks failed the test. Now, the initial reaction is that the bank tests may not have been stringent enough. For one, there was no scenario in which a sovereign like Greece defaulted on its debt. 2, bank book assets would not be marked down in the same way as trading book assets because they're assumed to be held until maturity. However, bad bond purchases could have been stuffed into the bank's portfolio while profitable trades were left at trading book assets, which would undermine the test's credibility as some of the bad bets would go under the bank books as opposed to on the trading books. Taking a look at the euro-dollar pair, we see that we treaded water for most of the overnight session, and then we actually rallied following a better than expected reading of German business confidence, testing the area just above 1.2950. However, around the New York Open, we saw the euro faltering as the criteria used in the stress tests was released ahead of time, and investors found them to be too lenient. Following the release of the stress test, we had some very choppy and volatile trading, but in the end, the euro wound up rising, climbing to the levels we had seen to start today's session. We'll see how traders digest the news over the weekend, and we have 2 clear levels now setting up with resistance at the 1.30 level, which was our high earlier in the week and to end last week, and support at 1.2730, a level of support this week and also one that changed from resistance to support in last week. Now, looking at the fundamental data outside of the European banking sector, we did see a strong business confidence report from Germany, which follows yesterday's strong manufacturing and services PMI, as well as industrial new orders data from the Eurozone, which gave economists a better than expected feeling about Euro region growth and helped the Euro to rally following its weakness throughout most of the early part of this week. Taking a look at today's IFO Business Climate Index for July, which is a closely watched gauge of business sentiment, we saw it rise sharply in July, underlying improving morale in Europe's largest economy. The Business Climate Index jumped to a reading of 106.2, up from 101.8 in June, as we had both current conditions and future expectations rise modestly. Overall, it shows that the German economy has been helped by a stronger performance in exports, helped along by the decline in the euro since late last year. In another surprise result, this one from the UK, we saw the British economy grow at its fastest pace in more than 4 years during the second quarter, according to government data released today, which indicated a recovery that gained substantial momentum heading into the second half of the year. GDP expanded 1.1% compared to the first quarter, outpacing forecasts for a 0.6% rise. The quarterly expansion was largest since the first quarter of 2006, and it followed a tepid 0.3% rise in the first quarter. The government said that the rise was broad-based, fueled largely by increases in business services and finance and construction. Industrial production saw 1% quarterly growth, while services expanded by 0.9% and construction jumped 6.6%, the largest quarterly increase since 1963. The better reading could affect a policy debate at the Bank of England, as the figures mean that the door on talk of further quantitative easing measures have been effectively closed, and that the chances of an interest rate hike before the end of the year now are higher. After slumping most of the week, the pound rallied in yesterday's and in today's session, coming close to test its highs from late last week. The pair had been using the 200 period moving average in late New York trading yesterday and in overnight trading today as support, and we had resistance in a downward sloping trend line that we broke at the beginning of today's global session. Following the UK GDP release, we saw the pound surge higher, breaking above 1.54, testing the area just below 1.5450. Then we had the pound pair, some of that rally as we had a little bit of risk, we had a bout of risk aversion as a result of the Eurozone falling following the release of criteria used in the bank stress tests. But similar to the euro, the greenback gave up those gains, and we saw the pound closing above 1.54 as we entered the weekend. In a look at the euro-pound pair, we see the strength today in favor of the pound as we moved from around the 0.8450 level at today's open to test 0.8316, our support level from last week. If the GDP data from the UK adds to the chances that we see higher interest rates from the Bank of England, that could shift sentiment in this pair, as we had seen the euro gaining throughout most of July. So we would watch for any break of this support at 0.8315 when we open up next week, which would open up the pair to further gains for the pound to the downside of this pair. However, if we come back from the weekend and the Eurozone stress tests have helped to further calm nerves around the European banking sector, then we could see the euro attempt to reclaim the 0.8530 level, which was our high in this week's trading. Taking a look at the dollar-yen pair, we saw the greenback gaining in today's session as we had U.S. stocks rallying in the second half of the New York session. Yesterday, this pair had met support at the 0.8630 level, our support from last week. And in today's session, we rose to resistance at 87.50, which was our high this week. So we could see that this pair is trapped in a bit of sideways range trading following our slide in the pair to end last week as we broke below a very important level at 87. Currently, we test the 200 period moving average, and a lot will depend on how equity markets behave when we come back from the weekend. The US dollar Canadian dollar pair traded rather choppy in today's session, but today's price action was confined to the trading range we had seen in yesterday's session. We tested our support at around the 1.0340 level, 44 level. And we look set to close near that level as we come into the weekend. We have now set up also a downward sloping resistance trend line. So this is a bit of consolidation in this pair. If we see the pair break below this support, we then look to test the 1.0280 level, our support from the middle of July. On the other hand, if we come back from this weekend and we see risk aversion as the main theme, we would look for a break of this resistance trend line, then a test of 1.05, and following that, our test resistance here at the 1.0580 level. And a look at our final pair, the Australian dollar US dollar, another commodity currency, another pair very sensitive to risk sentiment and the outlook for global growth. Yesterday we saw the Australian dollar rally past the 0.8850 level, which had been our resistance in this pair going back for a few months, right back here on July 17th. And in today's trading, we saw that the pair traded mainly sideways in a tight range. But we held on to the gains we had seen yesterday, and at the end of today's session, we even moved to set a new intraday high around 0.8970, and so that is a very good sign for the Australian dollar. Now, any data showing higher inflation in the Australian economy will feed the theme that the RBA is ready to hike rates once more, and we will get quarterly inflation results, both producer and consumer data, coming out early next week. Also, the RBA had said that it would closely follow the situation in the Eurozone, where the fear around the sovereign debt crisis has subsided, so that is another reason to expect further interest rate hikes from the RBA, which would support the Australian dollar. So with all that being said, let's take a look at the key releases that will be coming out next week. First, in the US, we start off Monday with new home sales. Tuesday, we get S&P Case-Shiller 20 City House Price Index, the Conference Board Consumer Confidence Index, as well as Richmond Manufacturing PMI. Wednesday, we get a look at durable goods orders and the Fed Beige Book. Thursday, we get the weekly jobless claims, and on Friday, we get our first look at second quarter GDP data from the US, as well as the Chicago PMI and the final version of July's UMich Consumer Confidence Sentiment. Around the world, as I mentioned, Sunday and Tuesday will bring our Australia Producer and Consumer Price Index data for the second quarter. On Wednesday, we get the Reserve Bank of New Zealand interest rate decision, where they're expected to hike rates to 3%. Thursday, we get a house price index from the UK, unemployment change data from Germany, as well as household spending and some other end-of-the-month releases from Japan. And on Friday, we wrap up with Canada's GDP. And that will conclude our coverage of the Forex markets for this week. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish everyone a great weekend.